Maximizing Price Stability in a Monetary Economy by Warren Mosler and Damiano Silipo. Section 6. Comparisons to Current Policy. We next compare an employed labor buffer stock policy with today's policy of using the unemployed as a buffer stock. In its elemental form, an employed labor buffer stock policy is one where the government offers a fixed-wage transitional job to anyone willing and able to work. We call it a transitional job because it's designed to facilitate the transition from unemployment to private sector employment. Note that we further suggest it is arguably not wrong to call this policy a structural reform that promotes efficiency and competitiveness. In practice, the size of the labor buffer stock would increase as demand for labor in the economy weakens, and the size of the labor buffer stock would diminish as the demand for labor in the economy increases, much like today's unemployment increases and decreases. The first beneficial attribute of the employed labor buffer stock versus unemployment is that it is more liquid than today's unemployed buffer stock policy, and therefore it would provide a superior price anchor in support of the ECB's single mandate. Additionally, it is more supportive of private sector growth in output and employment. Footnote 5. Indeed, it would also support the structural changes in the labor market aimed at increasing flexibility in hiring and firing by the private sector. Also, a labor buffer stock establishes the minimum wage private firms may have to offer to workers to attract them. End footnote. The primary reason for this superior labor liquidity and performance versus today's policy of using unemployment as a buffer stock is that employers prefer to hire people already working rather than hiring those who are unemployed. Footnote 6. There are several reasons why employers prefer hiring the employed rather than the unemployed. 1. People who have a job are proven to be interested in working. 2. You can't be sure why the unemployed lost their jobs. 3. The employed will adjust quicker to a new job. 4. An employed candidate has fresher job skills and known work habits. From Time 2011. End footnote. Furthermore, this resistance to hiring increases as a function of the length of unemployment. Footnote 7. Croft et al. 2012 and Kruger et al. 2014, among others, provided evidence that the long-term unemployed have a 20 to 40% lower probability of being employed 1 to 2 years in the future than do the short-term unemployed. Federal Reserve Chairwoman Janet Yellen, in a speech to the 2014 National Interagency Community Reinvestment Conference in Chicago, reported evidence of a long-term trend joblessness increase and of a decrease in the participation rate of the labor force after 2000. End footnote. This tendency leads to labor shortages, even as unemployment remains at relatively elevated levels. Therefore, what appears to be excess capacity, the rate of unemployment, is for all practical purposes not accessible. Additional benefits include the possibility of the transitional jobs performed by the employed labor buffer stock itself producing more useful output than that of the unemployed, as well as the positive socioeconomic externalities associated with full employment and the elimination of the negative socioeconomic externalities associated with today's unemployment policy. This proposal replaces the concept of the natural rate of unemployment with the natural rate of transitional employment, with the ECB utilizing an employed labor buffer stock policy to sustain inflation at its desired level, rather than utilizing an unemployed labor buffer stock as per current policy. Furthermore, we conclude that during an expansion with a given inflation target, the level of transitional employment will be less than the level of unemployment would have been had the ECB attempted to achieve its inflation target with its current policy. The difference is due to the greater ease of transition to the private sector and therefore a greater level of employment facilitated by transitional jobs when the economy operates at, for example, today's targeted 2% level of inflation. In other words, we claim that an employment buffer stock allows the economy to operate at higher levels of non-inflationary output and employment than in the current case where the NAIRU is the target of monetary policy. Moreover, and most importantly, a labor buffer stock policy is likely to reduce fluctuations in prices as compared to the current policy due somewhat to the countervailing effects of transitional employment when the private sector slows down, but to a greater extent when the private sector expands and seeks to hire transitional workers rather than unemployed workers.